Capital gains and losses for related parties. Let's dive in here. Good general rule, capital gains taxes apply to all sales of non-depreciable assets like land between related parties, except for a specific exception. And what is that exception? Well, capital gains treatment does not apply to sales between these related parties. Two spouses, where the basis is simply transferred. As mentioned, spouses we don't really consider that as a real transaction. And an individual and a corporation or partnership they control more than 50% of, where the gain is taxed as ordinary income. A lot of what we'll see here is formation of corporations and partnerships. This is going to be a big thing. A lot of sims, multiple choice coming from this, but we don't have to worry about that until we get to corporations and partnerships and formation of those. Capital losses and related parties. Well, losses are typically not allowed, as we see, right? The IRS is saying, yeah, you can't get the benefit of losses, but we have to recognize the liability of gains. Now, they're typically not allowed on related party sales transactions, even if the sale was made at a fair market value price. Basis rules and related parties. The basis and corresponding gain or loss for the second buying relative depends on whether their resale price is higher, lower, or between the first relative's basis and the lower selling price to the second relative. We'll see, and this is something that pops up in gift tax. It comes up here. We're going to have to take three amounts and choose the middle of them. And if that sounds familiar to you, great. If not, we will get through it and see it soon enough. Some more rules. Gain rules. Gains are recognized only when the future sales price is higher than the previous relative's cost basis. Again, these are rules, and we will have a slide where I'll actually show you the numbers, right? They're only recognized when the sale price is higher than the cost basis. I've got number one, a first number, second number, third number, and we choose the middle or the middle of the three. We'll see how that all works out on our slide eventually. But these are just the rules as I'm presenting them. I mean, feel free to come back and review this once we go through the numbers. I can't show it all at once, otherwise that would overwhelm the screen. Loss rules. A loss can only be recognized if the selling price to an unrelated party is lower than the initial purchase price paid by the relative who acquired the asset. Like I said, these rules, these are a lot. There's a lot going on here, and I would take the time to memorize these with the actual numbers next to you. So again, to reiterate, this very heavily tested on the exam, and it's tricky. It's something to make sure you know all these rules. And I'll skip to the slide quickly so you kind of get an idea what I'm talking about. We're going to have to choose essentially the middle. We've got three amounts. We've got a prior basis, a purchase price, and sale to unrelated party. It's going to determine what, we choose the middle amount, highest amount. We'll see that as we go further. But that's essentially what we're going to be looking at here. The new tax basis is the number that's in the middle. We'll dive into that, but that's what we got going on. This is going to be a lot to kind of focus on, but you can do it with enough practice, enough time. We'll do it together. Moving along with more rules. Rules for no gain or loss. Well, when the selling price to an unrelated party falls between the original cost basis and the related party purchase price, no gain or loss is recognized. And I don't even like to think about this too much. I like to just memorize the rules and just, okay, I see where the amount is, and then just think about the rule that applies, and there we go. Boom, that's the answer. Holding period and related parties. The holding period begins when the new owner takes possession of the asset, so we're going to reset it. Can't use someone else's long-term rule, holding it for a year for your own benefit. Let's see an example here. Capital gains and losses for related parties. We've got a gain rules example and a loss rules example. Alice bought a car for $15,000 and sold it to her sister Claire for $12,000. Claire then sold the car to an unrelated party, Emily, for $18,000. So we are going to get to use our rules that we were just talking about. Claire's recognized gain is $6,000 as the selling price is higher than Alice's cost basis. Now, Claire's selling price was $18,000 less Alice's cost basis. So Claire's gain that she's going to have is $3,000. Again, this is the application of the rules we were just going over prior. And if you want to go back and look at those rules again after the examples, feel free. You got a lot of examples because this is how you're going to really learn. It's how I learn. Very visual person. I think it's great. Loss rules. Mark bought a painting for $10,000, sold it to his nephew Luke for $8,000. Luke then sold the painting to an unrelated party, Olivia, for $7,000. We got three parties generally. It's the original person, the related party, and then an unrelated party. Luke's recognized loss is $1,000 as the selling price is lower than Mark's original purchase price. Luke's selling price is $7,000 minus Mark's cost basis of $10,000. So Luke's loss is going to be this $1,000 amount. Moving on here, rules for no gain or loss. Carol bought a bicycle for $2,000, sold it to her cousin Steve for $1,500. Steve then sold the bicycle to an unrelated party, Tina, for $1,800. Now, in this case, no gain or loss is recognized as the selling price falls between the original cost basis and the purchase price. We see here, just memorize the selling price fell between these two amounts, so no gain or loss is recognized. Just rules to memorize, get down, lots of free points on these questions. Steve's selling price, $1,800. Carol's original cost base is $2,000. The purchase price for Steve is $1,500. Since the selling price of $1,800 falls between the original cost basis of $2 and the related party purchase price of $15, no gain or loss is recognized for Steve. We're moving on to an example here, seeing the holding period of a transaction and assets and related parties. Well, Amy bought shares in a company for $5,000 on January 1st, year 1. She went on to sell the shares to her brother Brian on January 1st, year 2 for $4,000. Brian sold the shares to an unrelated party, Catherine, on July 1st, year 3 for $6,000. Now, specifically dealing with the holding period here, Brian's holding period starts from July 1st, year 2, when he took possession of the shares. He doesn't get to take any of Amy's time with the shares. So as such, this is going to affect short-term, long-term capital gains and losses, all that good stuff. By the time he sold the shares, he had held the shares for 18 months, 1.5 years, which sounds good. He's well over a year in that point, so he gets the long-term benefit. However, sometimes that might hurt him, and he would not have had long-term, he would have had short-term. Now, as promised and as kind of a preview before, here is our slide. This is when you're dealing with purchasing an asset from a related party, such as a family member. Key rule here, the new tax basis is the number that's in the middle. Here, we're going to see an example where the sale to an unrelated party, that's the highest amount. The sale price to the unrelated party, highest amount. It's the middle amount, and it's the lowest amount in each of these. These follow the rules we saw on the slides previously. And if you need to revisit these slides a few times, that's what I'm telling you right now. Go back, watch the rules again, look at the examples, back and forth. It may take a few times around, and try to give as many examples as possible to demonstrate for you. But if you have to review things again, that is totally not an issue. Now, first off, in this situation, like I said, we're going to generally choose that middle amount. So the prior family member's basis is always going to be $60,000. The purchase price is always going to be $40,000. So the tax basis is going to be here. It's the prior family member's basis, which is 60. The new basis is the number that's in the middle. Here, when the sale price is in the middle, this is the new basis amount for the asset. And in this case, the purchase price, because that's the middle amount. 40 is in between 60 and 25. 50 is in between 40 and 60. 60 is in between 70 and 40. So that's the new tax basis. Now, what about the gain or loss realized and recognized? In this case, this is going to be $10,000. That is going to be from basis, selling price minus basis, right? That's pretty much how it works. In this case, because the basis is 50 and the selling price is 50, there's no gain or loss realized or recognized. So before, I might have been saying those rules to you and you're thinking that's kind of arbitrary. Well, why is there no gain or loss? This is why. First step is what's the basis? Because how do you determine the gain or loss? It's the selling price minus the basis. So if the selling price and the basis are both 50, that's going to result in 0 gain or loss. And then in this case, what's our basis? Our basis is going to be 40. Our sale is 25. That's going to result in a $15,000 loss. This is a pretty important slide. Make sure to note it. Make sure to look through it, practice it, screenshot it, do what you have to. And let's keep moving along. All right, more examples here. Sarah bought a piece of land for $50,000 that she sold to her cousin Jane for $40,000. The $10,000 loss is disallowed. Jane then sells the land to Lisa, who's an unrelated party, for $55,000. What is Jane's basis in the land and her recognized gain or loss on the sale to Lisa? Well, Jane's recognized gain from the sale is $5,000. And how do we calculate that? Jane's selling price was $55,000. Jane's cost is $40,000. Well, how do we get this disallowed loss here? Well, what's the basis? Basis, as we've seen, that's the middle number. So we know that basis is 50,000 right there. That's how we get our basis. Again, following those rules we saw on the previous slide. So our disallowed loss is that difference, the 50,000 and 40,000. And what is our gain that we're actually going to recognize here? Well, that's the difference between the selling price and the basis. So if you wanted to just skip to the end, right? It's selling price minus basis, that's $5,000. The remaining portion of the difference here, that's going to be a disallowed loss. Pretty straightforward. Practice, practice. Love the examples of the questions. Let's keep moving along. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.